If the borrower declares bankruptcy, is any money from the investors lost?
Yeah, it's a great question. Really around what happens if someone defaults on a loan. The reality is that before any sort of bankruptcy or something like that, a loan would go into a default when a borrower missed a payment. And what happens when a borrower misses a payment is that the interest that they're paying goes up. There's an incentive for them to, you know, catch up, get out of default because while in default, they're accruing interest at a higher rate. There's another major reason why they're interested in curing default, which is that these investors typically have significant amounts of capital of their own capital um, also invested in the outcome of this property. And so they're really not wanting to go through any sort of foreclosure or bankruptcy process where they lose the property goes through some sort of short sale process where the lender, in our case, let's say, um, is going to be made whole as long as the property can be sold for 70% of the value of the property, and that's assuming a max loan to value lending scenario. Oftentimes, the loan to value or loan to after repair value might be more like 50%. And so there's strong incentives in the process for the borrower to cure a default. If they aren't able to cure a default, then that loan would essentially go through foreclosure, and the lender would ultimately foreclose on the home and take possession of the asset, and then have the option to sell that asset. And so that's a little bit about what that process looks like. A scenario where an investor might lose money is if there's a default on a loan, the lender, arrived in this case, takes possession of the property and sells the property for less than the loan value. And that would be, the likelihood that an investor would, let's say they've lent 70% of the value of a property, that means that that property would need to be sold for a 30% less value before an investor loses the first dollar on that note. And that's one of the benefits, I think, of investing in real estate backed debt, is that there's that margin of protection in that loan to value or loan to after repair value for investors.
And to put it in perspective of kind of would investors lose money in the sense of like, would the share value go down? Would they experience principal loss for their shares? Now, certainly you could have principal loss on any single loan itself. So if we go back to the example that we were talking about with an 80% recovery rate, just for simple numbers, let's say that they borrowed $100,000. We had to go through the foreclosure process and the credit fund got paid back $80,000 net proceeds. So it may seem like it's a loss, but you have to remember that it's also one of many loans out there. And if we're paying out, say, 8% on average into the credit fund, and then we experience what let's say the underwritten credit loss amount of 0.4%, then it's as if the yield, instead of being 8%, was really 7.6%. So, we can think about the loss on one individual note, but if we think about the loss of investor principal in the shares of the credit fund, there's not really loss until it falls even below the amount of interest we're earning, because we're getting yield every single year. So let's say after 2 years, there's 8% each year. So, you started with $100 and you have still that $100 of principal plus $16 of interest. But there's been, a couple of defaults where you lost 40 cents, 0.4%. So that's kind of how we think about the credit loss numbers. And why we like debt so much is that it has a high yield. It has that that security of the real estate, the repayment of that. So when you net everything out, you earn a little bit less interest than the headline amount, but principal is quite protected from a share value point of view.